Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, joins us on the show with his thoughts. Mihir, so good having you. Thanks much for joining in. What do you expect? I mean, this coordinated central bank action, can it thwart the negative sentiment around world markets? And India had that peculiar case of being slightly different than the rest of the world yesterday because of the two new detections. Can that, overpower the sentiment around that too?
See, I think it was always expected that if markets really go for a tailspin like they did last week, central banks will at least talk about doing something. Whether they can or not is a different matter. But that expectation is always there, and that central bank put concept has been around for quite some time because of lackluster global growth and the need to keep asset prices inflated globally. So I think it's no surprise that the market is beginning to expect such a measure from the central banks. We did see some murmurs from the Bank of Japan yesterday, and today there is this meet of the G7 central bankers conference call to discuss the way forward. So keeping asset prices and market sentiment positive is a priority because I think the Western world is really dependent on stock market wealth. Probably less so in India, but the Western world is definitely, given the pension funds, etc. requirement. So this is to be expected. On the face, or given that this is coming at a situation where you have such negative news, at least in the short term, from the coronavirus, we can see these whiplash kind of moves, both plus and minus in the markets like we've seen in the last few days. So I think it's going to continue for a while.
The downside, what you mean?
No, this volatility, 3% up, 3% down, those kind of moves will continue because in the short term, you really have, concerns about the virus spreading globally. Till last weekend, it was looking like China was the epicenter, and probably it will get contained to China and South Korea and Japan to some extent. But this week, the news has been a little bit negative, where we see more countries, beginning to see infection. And obviously, there is, not going to be one patient. There will be multiplication. So the good news is that China has been able to control it in about a month and a half. So the kind of the rule book or the SOPs, operating procedures, are known. So my guess is that countries will be able to contain it in the next few weeks or so. But it's going to be a bit of a pain. The human cost is of course there, but it's not such large numbers because the mortality rates are so low. But the stoppage in economic activity that is required to contain it is what is spooking the markets.
Okay, so let me ask you, domestic institutional investors have still been buyers, even in this falling market and the turmoil that we've seen. Monthly, there is inflows coming in through the mutual funds. That money has to be deployed.
Yes.
So in light of that, these levels should remain attractive? I mean, considering that at least domestic money will continue to pour into the markets?
Yes, they should. Only thing is, we have seen a lot of action by FIIs. We've seen about 12,000 crores of selling in the past, about 2 weeks or so. That's close to a couple of $1 billion.
But now this liquidity comes back.
It should. We've also seen a lot of movement in the F&O. So if you look at the FII futures positions, they actually have gone short by almost $1 billion extra. So not only did you have the impact of $2 billion of cash selling, you probably had $500 million of F&O selling also. So this will get unwound, you're right, if things come back. If global liquidity, as we are talking about, is even more flush than what it was before, then we should see some bottom at some point in time.
Okay. From our market's perspective, and since you said that these whiplashes could continue, they'll die down at some point of time and then we'll return to normalcy. What is normalcy then? I mean, here, let's assume somebody is able to digest the volatility, is not doing leverage trades and wanting to invest right now. Are those... somebody made a point yesterday they should play the recession playbook. Would you do that? Or would you indeed buy into quality names right now if you have the stomach to digest the volatility?
So it's always a good time to buy quality names, especially the consumption names, because...
No, I'm just thinking of tactically.
When you say the recession playbook, what does it mean?
So Jeffrey Dennis yesterday was saying that typically in a recession playbook, you would have gold higher, safe haven assets higher, treasuries higher, and equities lower.
Right.
Would you play that playbook? Or would you not?
It's not that cut and dry for India, because the linkage between the bond markets and equity markets and the commodity markets is tenuous in India. I would not kind of use that rule book in India.
Okay.
I would rather look at the bond markets separately and the equity markets separately.
Okay, so buy into quality right now because the opportunity is fairly lucrative, valuation-wise.
Valuation-wise, a lot of stocks have come down to almost 5-year low valuations. Even in some of the large caps, cyclicals, you are seeing 5-year low valuations.
Playing cyclicals?
Well, they're looking tempting, though by heart I'm a growth investor, but some of the names are really looking tempting.
You know, I assume most people who wanted to invest at levels of index touching 12,400, for them this is a party. I mean, it's an opportunity to get in at a much lower valuation and ride the rally back to 12,400 as and when it happens. So technically, from a growth investor standpoint, who is ready to put in money for the next 5 years, this is opportunities galore.
Absolutely. Only question is whether you want to do it in one shot or whether you want to time it out, because we've just seen the beginning of this scare, so to say, for India, and we don't know how it's going to pan out. So my guess is that this uncertainty will keep a bit of a cap on the sentiments, at least for a few weeks, till the time that we are comfortable that, okay, it's only restricted to this and this and this. Because right now we can't quantify the risk. And as I said, the human cost is high, but it's not very high in terms of numbers. We have seen deaths. Of course, it's not good, but it's only a few hundred deaths, maybe a couple of thousand in China, etc. Not very material in the global scheme
because
of
the
things.
mortality rate
is very low, but
is lower.
To contain this, you need to stop a lot of economic activity, and that's what's hurting the market. So you might continue to see downgrades happening as countries try to stop more and more economic activity to contain this. Manufacturing, travel and tourism, business meetings, everything's getting shut.
What is the impact on EPS that you see for the rest of the year?
For India, it's very difficult to quantify because 50 to 60% of the growth is anyway coming from financials. So I don't see too much of an impact on the financials. If there is a volume slowdown in loan growth, they'll probably use pricing power to maintain their earnings. So financials, especially the private sector, will kind of maintain their growth. You may see most of the cuts, if any, on the global cyclicals, which is metals, oil and gas, utilities, those kind of names.
May I ask you, I mean, this is not asking you for a comment on a particular company, but when you look at we have the ushering in of the first cards business in the country, and the street is completely divided about how do you value such a name, so on and so forth. I'm not asking you for the right valuation because that will amount to a call, but I'm asking you whether you would look at it on a price earnings to growth basis, whether you look at it a price to book basis because it's a pseudo NBFC of sorts, which is into the lending business and a fee business, and whether the niche premium that such a business could attract would be similar to what maybe the first AMC got or first small finance bank, etc., would have gotten, or now those premiums may not exist. How do you view this?
I would not say those premiums may not exist because those premiums are still there. The high P stocks have not corrected by like 50% yet. So I think there is a space and demand for good quality. And the premium for visible growth is still going to remain, I think, in these uncertain times. So I would say any business which delivers good ROE, ROCE, which is the case here, and has good visible growth for the next 2, 3, 4 years, will continue to command premiums, irrespective of whether it's an NBFC or any other sector.
Mind you, viewers, this is not a call from Mihir Vora about SBI cards. He's just talking about businesses at large which may attract levels or investor interest in any fashion whatsoever. Mihir, so good chatting with you today. Thank you so much for taking the time out and being with us. Important day to have you, so I'm glad you were here with us.
Absolutely.
Thank
Pleasure.
you.
Thank you.